JTW International, whether investors might have been encouraged by what they heard this week.
Well, I think you're seeing a kind of classic, conservative market where good news is discounted and bad news is overemphasized. So while there's been some weakness in the earnings, it hasn't been horrible, but they've been misses from higher valuations. So I think you're seeing a normal adjustment down to kind of levels that make investors a little bit more attractive. And also you're seeing a little bit more bottom picking down here on very, very volatile days, but not the amount that we need to see in case you're going to see a turnaround in the market.
Let's look at the interest rate moves that we had. I mean, do you think they are perhaps behind this slight rally that we're seeing today? Very modest, of course.
Well, I mean, interest rate cuts are always good for the market sentiment. So the vast movements that we've seen in the U.S. quite dramatically. Also now the U.K. has finally come in and cut, and the kind of, dovish statements out of the European Central Bank yesterday, even though they kept rates on hold, has given investors a little bit of hope that maybe they'll come around to rate cuts. So generally rate cuts, are encouraging. However, too many rate cuts might actually turn the other way, that people are very concerned about recessionary impacts.
Okay, well, looking at the real economy, is it that all we're going to be looking at now as we try and work out whether we've hit the bottom yet? I
think it's going to be an increasingly important information. I think since the U.S. has been so aggressive in cutting rates and will continue to do so, I think the data, specifically GDP, recovery data, unemployment across Europe and the U.K. is going to become increasingly important. And that's what the market's going to look at. So I think you're going to turn from sentiment and market psychology to a little bit more of data, which I think will be encouraging for people because it'll be a little bit more sensible to look at and trade.
Okay, but looking at the data, do you imagine that we are going to see genuinely a recession, possibly a long recession, or is there still more than a chance that we'll just have a slowdown?
Well, I think if you look in the U.S., if you had to guess, the estimate 50 to 70% of the market is pricing in a recession. So some valuations are already down so low that the bad news is already baked into the price. I think, in the U.K., it's taking a little bit longer for that to filter in. There is some hope because the data has been mixed. Bad housing data one month, moderate housing data the next month. So you're not really getting a consistently weakening trend. And in Europe, you're just starting to see some weakening. So I think, the perception is that the U.S. is deeper into the recessionary talk and potential zone. The U.K. is behind it, but heading in the same direction, and Europe still doesn't know which way it's going to go.
Okay, well, given that there might even not be a recession in the Eurozone, let's say, and definitely not in places like India and in China, does that mean that actually once we find some kind of bottom and the European markets, the continental European markets and the Asian markets, that they could actually see some gains this year?
Yeah, I think you're easily going to see that. I think Asian markets will continue to outperform, especially as you see they have some resilience, more volatility, so you have to have a strong stomach, obviously, in the market moves. But nonetheless, you can kind of see there's growth there. It's consistent growth, and it's actually kind of large growth, especially if you look not just in India and China, but also Russia, for example. These countries are continuing to grow at large GDP numbers. And I think Europe probably will moderate and probably could show an increase by the end of the year.